when you're looking to invest, you want to be passive and you want that passive income. So buying real estate is far from passive, but investing in real estate is absolutely passive. So make sure you're doing the right strategies.
This is the Passive 25K podcast, a podcast built around the vision of creating wealth through passive income for ourselves and others. The idea of creating income while you sleep seems like a dream come true, but for most professionals, turning this into a reality is a different story. On this show, you will hear real people breaking passive income streams down to the basics, giving you the next steps to start your own passive income journey. If you're new to the show, my name is Kyle Reedstrom from Fargo, North Dakota, where I get to work with my team of agents and investors each day to complete our goal of $25,000 a month in passive income. Now, let's get right into our next conversation. This is the Passive 25K podcast with Kyle Reedstrom. We are the home of Passive Income University. We help working professionals with one source of income start and complete their passive income journey. Find us at p25kg.com. If you're looking for next steps, click that button. Let's talk about your game plan. But today we're diving back into the topic of funds, syndications, and REITs, and what it's like to truly create stress-free wealth using these commercial real estate investing vehicles. Justin, a young and hungry investor that has made his name for himself by doing this exact thing. We get to have Justin on the show. Glad to have you here, man.
Oh man, I'm excited to be here. Love the show. Love you got the decked out decor back there. I don't know if anybody's watching on video, but love what you got set up.
I hope people watch on video. We got a crispy video to watch, but I think a lot of people are all about that. You know, that Spotify listening while they're driving, whatever. But Justin, correct me if I'm wrong. You just started rolling this stuff a couple years ago, and now you've reached accredited investor status doing just this. You're getting in this commercial real estate world using syndications, funds, REIT style investing. I want you to give a little intro to our audience in your own words, man.
Yeah. So, I mean, I've always been in the real estate game. When I was 18 years old, I got my real estate license actually. So right out of high school, really knew that I wanted to be in that field. Was in the very competitive market in the Bay Area, what we call the East Bay, just over the bridge. And so when I was hustling out there as an 18-year-old kid, did that for a couple of years, I worked with a lot of investors. And I saw, what they were doing. I saw the lives they were living, and I knew that that's what I wanted to do. I wanted to eventually step away from brokering and step away from the very high pressure, high stress sales role that I was in and into more of an ownership aspect of my life. So I knew that was the ultimate goal. Now, in between then and now, I did different things, went to college, joined the military, did a lot of different life stuff. But just, about 4 years ago, really started diving back into, hey, what does it take to be a professional real estate investor? How can I set my life up in the future so that really I don't have to work my whole life? That was the biggest goal. Is I knew what it was like being a high performing sales professional. I knew the hours I had put in and the stress that it had caused. And really, I didn't think that I had the bandwidth to do that for 40 plus years. So I started diving into real estate investing, and really, I dove down the single family home route. I think there's some people that have great success there, but those numbers just didn't really excite me. So I looked into doing bigger deals, apartment buildings and self-storage facilities and strip centers. And that stuff really excited me a lot more. So got into the multifamily syndication space as an active partner. I also invest passively myself, predominantly into our own deals and our own funds, but I kind of have my hand in both there. And so that's been really the ultimate journey. And now what I do with my days is I spend my time, it sounds like just like you, helping people invest passively. And that's really what gives me the most joy, is showing people how to do this stuff. So that's how we got introduced today.
Yeah, Justin, I think a lot of your intro, and I always love it when people explain their story, because I think our audience is going to resonate. I think there's a lot of people out there have the same feeling. I'm working hard. I might even enjoy some of the work I do, maybe not all of it. But I don't know if I want to do this till I'm like 65. You know what I mean? Like, yeah. This is not I hope people are thinking about this. The people listening to this show are definitely thinking about this. And so, I mean, you got, I just want to take a little section, dive into this. You got to the place where you're like, I gotta do something. I gotta do something. Mm-hmm. You, how did you like break that, like just break the surface of going down like this more multifamily style route? Like
Yeah.
it seems kind of daunting is why I'm kind of alluding to it,
Yeah, yeah, a lot of books for the more, and then I had a mentor that I had paid, so I paid for a mentoring program, and those are fairly expensive just relative to where you're at in life. But I broke into it really starting back when I was in real estate sales. I had a great mentor, thankfully. And he was really the one that instilled that mindset of you can do bigger things. I mean, I was 18 years old. I was hustling in what was the third most competitive real estate market in the country at the time. And I'm sure it's still up there. We actually had a listing that was featured on $1 Million Listing, San Francisco or Bay Area, whatever they call it. So I was an 18, 19-year-old kid. My average home sale was $2.2 million. So with that, I was so intimidated to be in that market and to be competing with these other generational real estate brokerage families that he just really hammered it in. Like, don't be afraid. I mean, he started when he was 18, 19 years old too. And he had a amazing career as a broker, and he was a developer when I had left that team. And he really just let me know, you can do things bigger if you want to. Like, there's really nothing that's stopping you. The guy or girl who's doing it is not more talented than you, or is likely didn't start out more well connected than you. Like, they just started doing it. So I was really, really fortunate that was something I was kind of introduced to, that entrepreneurial mindset from him. And that really helped me a lot.
Dude, that's super valuable. Justin, if you don't mind me asking, how old are you right now?
I just turned 30.
Okay, just crossed into the 30s, right?
Yeah.
20s are for learning, 30s are for earning. That's what I've heard. But no, dude, I wanted to showcase that because I just think we have to break down break the mentality of I have to wait to do this, or I'm too young to do this, or you can do big things. I wrote that down. You can do bigger things, and I think that was huge advice. Getting back into this world of commercial real estate, there's the three kind of things I mentioned: funds, syndications, and REITs. I want to try to give the audience, I like to lay a good foundation. Can you give us like the definition? And I like it doesn't have to be perfect definition. In your words, what are these things? When people hear about them, but really, what are they?
Yeah. So I'll start out with the REIT, because I think that's what most people think about when they think of this type of investing, because they're really popular on social media. They have very low buy-ins. So there's a big audience base that they market to. A REIT is a real estate investment trust. And essentially, you can micro invest in these things. Now, they can be public or private. Now, the distinction is public is they're actually stocks. Okay. So if you invest in a public REIT, they're actually stocks that you hold, and therefore they have the pros and cons of the stock market, right? They're very, very liquid, but they're also very, very volatile, and they respond really to market sentiment, not as much property performance. Versus private REITs, they're private, they're not as liquid. You do have to submit a ticket to get your money back, and you can be denied that. The returns are historically about a point or so better, and you actually get some ownership benefits of them as well. So they're not as liquid. So you get some of that pros and cons of owning real estate. And they're great ways for people who are just starting out to get bought in, because their minimum is usually just a couple $100. So you can get started for really quickly. The returns historically have outpaced public markets by about a point or so if you're on the public sectors. And you can put in, $500 into these things and be instantly diversified into massive, massive amounts of properties. You can, in all sorts, all over the country. So I think that is one of the biggest selling points to REITs, is there is massive amounts of diversification for a small amount of money that you can access. And the trade-off to that is, compared to the other two strategies, the returns are pretty light. I think historically, private REITs have returned about 9%. I think public ones closer to 8% over the long run or annually. So, that's better than nothing. And it's better than what you're getting right now in savings accounts and even high yield savings accounts. But, if you want to really, really play some games and get some money, you can look at syndications and funds. So before we dive into those, do you think like what sticks out there that maybe some people might want to learn more about? Or maybe what did you want to learn more about REITs when you first learned about this stuff?
Yeah, dude, I appreciate that. And that was a really great breakdown. I think the highlight there, getting into these things, there's a barrier to entry, and they've kind of removed that with some of the lower buy-in.
Yeah, I think that's massive. It's interesting because when we talk about like older generations or our parents, a lot of times it's, hey, they had it easier in building wealth and things like that. And while in the macro, I think that's true, there's also technology that's made it that's given this generation unique abilities that past generations haven't. Access to REITs is one. I mean, a lot of these are apps now. Like you just link up your bank account, you download the app, you can see it right there. I mean, they, in a way, make it so easy to invest in these things, which is really, really great. People should have access to them. And if you don't know anything about real estate, you just know it's a good asset to be in. I would do something that's passive. Don't go in and go buy a duplex or something, or it's like buy a house. Like you're probably gonna mess that up if you want it to be passive. So they give you really, really great access to instant diversification at the sacrifice of some historical returns being a little bit lower than other real estate strategies. But that's really the trade-off you're playing to get in the game quicker.
Yeah, and we talk a lot about the pendulum of action and analysis, or learning. And if you're listening to this podcast right now, you're sitting in the I'm learning about passive income or real estate. And this is a cool way for you to get into action mode, even if you're not, if you haven't invested yet, you're thinking about it, but take some money. It doesn't have to be a ton, and put yourself instantly diversified into something like this is a really cool way. Don't focus on the dollar amount of returns. Focus on the percentage. Know that their zeros can be added over time, right? I think there's a cool step here. And by the way, this is completely passive. I mean, this is the definition of passive income. So really cool there.
I think that's such a huge aspect and the reason why we talk a lot about like REITs and syndications and funds is that is passive investing. I think real estate is so glorified on social media by, hey, buy a building, a property manager does the work, the contractor does this, and then you collect a check every month. Not a single person who owns a notable portfolio will tell you that that's the case. There's always work to be done, or there's tons of money on the table. So to really run property right, you're essentially taking on another job. When you buy a property, you become an employee of that property. That property cannot survive on its own. You become its employee. Now you can hire that stuff out, but that sucks up a lot of your yield, or nobody's going to treat your investment just like you would. So when you're looking to invest, you want to be passive and you want that passive income. So buying real estate is far from passive, but investing in real estate is absolutely passive. So make sure you're doing the right strategies.
Yeah, this is a cool topic, man. And I mean, you hit it on the head. You said it best. Buying real estate is not passive. Investing in real estate really is. In your network, is this a conflict? Do you see people that are like, hey, I'm going to head this direction, and it's kind of a facade, like they don't understand the work involved, and you're really, you've done both, Justin, and it's like, hey, I really want to get on this passive side. Yeah.
So I see it more than I would like to, because a lot of times when I have investor calls with people, and we run syndications and funds that I know we're going to talk about here in a minute, but really they come to me a lot of times. They say, hey, obviously I want to invest in real estate. They heard me from somewhere, or they introduced me from somebody, and they say, yeah, I'm thinking about either, buying a duplex or a triplex, or investing something like you. And I said, well, what's the goal? Yeah, I want passive income. There's only one option. It's not going to be to buy the duplex or the triplex down the street. It's going to be to invest in some strategies like this. And I'd say about, half the time they take my advice, and about half the time they don't. And they say, hey, I've decided to buy a, duplex or something. And that's totally fine. I think that's a learning experience you need to have. But one of the worst things is when you have a full-time job, you have a family. A lot of our investors are salespeople. So we really cater to that sales niche, and it's a very, very demanding job. So a lot of times they spend all day working and hustling and grinding to make those big checks. Then they come home and now they've got things to do at their property. And that's the tough part, because these, again, they're not liquid investments. You can't decide one day, oh, I'm overwhelmed, I just got to take something off my plate and just, get rid of the property. Even if you make that decision, you're still in there for, 3-4 months plus if the markets are fine. So they're not liquid. So you really have to make sure when you take this journey that you're in it for the long haul. And the fact is, not a lot of people, if they understood the work that went into it, would be okay taking that on for the long haul. If they had another job, a regular W-2 that they weren't planning on leaving.
Yeah. Yeah. For any of the investors out there that might be listening, they're like, hey, I'm arms deep in real estate investing. That's not a bad thing. Justin's just saying, hey, there's the hustle, and the hustle's involved there. Let's call it what it is. And I love the word "and" with this conversation. I think really, really high level people are maybe playing, because the hustle also is where, you can really have some bigger returns when you get a little more active with this stuff, right? We're going to talk about syndications and where you can get active and where you can be passive with those. That's where some returns might lie. But if you're kind of playing in both places and you can, stock market and the active hustle of real estate and the passive side, I think you can really create a pretty cool ecosystem if you're going to try to hit those goals.
I agree. And there's a lot, like you said, there's like, where do you want your yield to be? Because a lot of people, they want the big, sexy returns that they see in what's called value add real estate. But that stuff's a lot of work, right? You get paid relative to the risk and the work taken for a property. And so, it's not as simple as buying a property. I'll hire a contractor and, in 3 months, I'll have this beautiful product. We've had hundreds of thousands of dollars stolen from us from contractors. Like, you have to, and we're very hands-on. You have to be so hands-on with these things. That is the biggest fear, is that social media has glorified this field so much as being passive, and you could just throw it by the wayside and it'll, it's always goes up, and the manager does the work and the contractor does this, and that gets a lot of people in trouble.
Yeah. That's awesome. Awesome conversation. And I want to get back to, you touched on REITs. Let's get into the funds and syndication side there.
Yeah. So funds and syndications are very, very similar. Let's start with syndications, because I think they're a little bit easier to explain. The syndication is essentially going to be one property that you're buying. And what happens is there's two parts. There's the active investor, which is called the general partnership, and the passive investors, are called the limited partners. So the general partners will do a 100% of the work on the property. So if you're a limited partner and you're kind of in this general partners ecosystem, they're going to come to you one day and they're going to say, hey, we have this really amazing deal. This is the business plan. Here are all the pictures. Here's our marketing deck. Here's like the timeline. Here's the investment, the financial projections. We're raising something, $20 million to purchase and rehab this property with the goal of selling it in, 5 years. And, we project to double your money in 5 years, whatever the case may end up being. And they'll say, we need $20 million for our down payment and our closing costs and our rehab budget. So instead of us writing a $20 million check that we probably don't have, we're going to take our investors on and say, hey, for a minimum of $50,000, we're going to bring on, 100 investors who come in and get essentially a piece of the pie, right? They get a piece of it for the equity they bring. And in exchange for that money, you get ownership in real estate. You get a percentage of the distributions every month or quarter, whenever they pay out, and you get the equity upside as well at sale or refinance. A lot of times these value add strategies, just very high level, most people will look to double your investment in about 5 years. So I'm going to say a range between 17 and about 23% average annual return if things go well, right? And so that's really one of the most effective ways to invest passively in real estate. And once you fund the account, really all you do after that is you have usually monthly updates that you get on the property. You get your distributions and you just stay informed. That's really it. I think that's my favorite way to invest. Now with the fund, it could be the same way, except it might be reversed. Your money might come first. So the operators, the general partners might say, hey, we have a fund where we're looking to raise $20 million and we're going to take that $20 million. And in the future, we're going to buy properties and they're going to be apartment buildings. They're going to be in this market. Usually they'll have some type of stipulations to give you some guidance, but there's less control over what properties you're investing in there. Versus the syndication, you have total control because the property comes first. They bring the money after, you bring the money after it's been identified. In a fund, you might bring the money first. The properties might come after. So a little bit of a kind of when does the money flow? That's probably the biggest distinction. A fund can also be a little bit more diversified. They might buy multiple properties with that $20 million, or they might just buy one big strip center. There's different goals, but a fund could have more properties and usually the money is going to come first.
That's really insightful. It's almost like with the syndication, you're buying the investment itself, like the property.
Yeah.
With the fund, you're kind of buying the team almost. You're buying like the brand or the people because you're trusting, like, I know you guys are going to invest this money well, You might have an idea where they're going to go with it, but yeah.
Yeah, that's a good way of seeing it. I think, in both scenarios, you're betting pretty big on the general partnership because they're the ones that have to execute on the business plan. But
True.
on one, it does require more trust, just like you said, because you may not have a property right there. Maybe a property that if the property had come first, maybe you wouldn't have invested in that one if it was a syndication, but you already put in your 50 grand into the fund, and that's kind of one of the properties that they bought. So there is a little bit more of a trust gap there. And for some people, that might be better where they don't even want to look at the property. They're just like, hey man, I know, like, and trust you. Just, here's 100 grand. I'll look out for my distribution next year. They may not care about that. So I think it does require a little bit more trust. And some people, if they want to be more hands off, or they really don't care about what properties you bring, they just like you, that might be a better option.
That makes sense. That makes sense. And I think that's applicable. I think there's maybe people listening or people that have kicked around the idea like, hey, kind of had some of these conversations with people. Maybe you're the hustle, you're down that general partner style mindset, and somebody wants to invest. It's like, hey, they're kind of buying into you, maybe not so much the thing yet. Justin, when it comes to your personal story, getting into this, and I think this is really applicable because it's somewhat fresh and you're in it. What did you do first? Like, did you just say, hey, I saved up some money, made some money, and I invested as a limited partner in something? Or did you get into like a general partner group right away? Like, what was it for you?
Yeah, man, I went into a general partner group right away. So our very first investment was a 40 unit property that we had purchased. It was me and three other partners. And really, I would have loved to be a limited partner, but I didn't have the money. To be honest with you, at the time, I didn't have the money for it. There's certain spots in the general partnership that you can fill that, it's nice to have money, but you don't necessarily need it. You can do more of the asset management, or you can find the deals. I did a lot of financial analysis and projections. So, it took me about a year of underwriting 5 properties every single day to find the deal that would work. So because of that, I didn't bring a lot of money to the table. I brought more of the deal and some of the asset management. But no, I would have loved to have been a limited partner first. I think that would have served me a lot better. It would have saved me a lot of headache. I would have made more money. I just didn't have the resources at the time. So if I had the money, could go back, I would have been a limited partner first for sure.
Yeah, and that's cool to hear. I know that we could go down a whole rabbit hole with the general partner, like how you'd structure this if you're in the general partner side, but there's different roles to play on that side. And if you are somebody that's looking to be a part of a group like that, it comes down to what value are you adding? Yeah. Are you going and getting investors? Are you a primary fundraiser? Or are you, like Justin just said, literally hustling, underwriting 5 deals a day? And these are big deals to underwrite, man. I know there's probably similarities, but man, that's a grind. I give you kudos on that. But you get to see a lot of stuff, man. There's no way you're not an expert after those hours,
Yeah. And I always knew that wasn't the end goal for me. Just for my skill set, I'm much better doing things like this, like doing podcasts, hosting our show, meeting with investors and raising money. Like, that's what I love to do. Talking to salespeople about investing and like how they can replace their income with passive income as fast as possible. Like, I love those things. I hate financial models and projections and underwriting deals, but it was a necessary thing that I felt I should do if I'm going to be a steward of people's money and they're going to invest in our funds that invest in different deals. I should have that experience of asset managing, of underwriting. So when I look at deals, I know, hey, they underwrote it this way when maybe I don't agree with that strategy, or hey, when they're in asset management, they might face these challenges that you can't really underwrite to. You just have to be in the business and know those things. So I think it's made me overall a much better fund manager, and I'm very grateful for that, but definitely knew that it was going to be a short-term thing. Wasn't really my strength.
Awesome. Well, thanks for sharing your story. And we're going to take a little break, but when we come back, I want to get into, I always like to poke it from both ways. And you've touched on a few of maybe the cons or the downsides, but really we've talked some pros, why you want to get into something like this with passive investing. But I want to hear some more of the drawbacks on these, really kind of round it out when we get out here after the break. So we'll be right back. Hey gang, really hope you're enjoying the episode. I want to take just a little bit of time to highlight another episode that we have, episode 35, Freedom Through an Online Business with Sophie Howard. We shot this episode and got super excited about the offer that she had to provide, which is a community and a course teaching you how to buy an online business and create a truly passive revenue stream. When it comes to the passivity scale, Sophie's stuff is all the way 100% passive. She's living a fully passive lifestyle right now, doing things that she loves and working in businesses that she's really passionate about. And so if you haven't yet, check out that episode 35. And if you're curious about Sophie's program, there's actually an affiliate link in the show notes of that episode. You obviously get Sophie's course and her community, but it also helps us fund the operations we're doing with the Passive 25K podcast and helps us achieve our passive income goals too. So we think this is cool synergy. We think it's great value for us, for her, and for you as someone that's looking to add a revenue stream. Definitely check it out. And now back to the show. We are back on the Passive 25K podcast with Kyle Reedstrom. We are talking pros and cons of REITs and syndications, these vehicles to create passive income. We're talking with Justin Moy. Justin, you touched on kind of the definition of these vehicles, REITs, syndications, funds. We definitely touched on, hey, what can these things do for you? What are some of the pros? How can you use these vehicles? And I mean, if we want to round this out, I really want to talk about the cons of this. Like, what are some of the downsides we can look for? This might not be the easiest because, I mean, this is kind of what you do, but at the same time, everything's got the pluses and minuses, right?
Yeah. I'd say the biggest downside to it is when you're investing passively, you have to really be trusting of the sponsorship team or the team that you're investing with, right? You can invest in great markets with great assets in great macroeconomic environments, but when you're investing with these groups, you are essentially outsourcing that control. So you want to make sure that group is a really, really good custodian of your money. You want to make sure that their values and their incentives are aligned with yours. Now, one thing that I really love about this space is most of our compensation is based off equity gains. So there's not as many, where there's some advisors that are just purely based off fees or they get bonuses for selling certain products. Like, we are investing in the deals that we're advertising as well. And we expect to make most of our money based on the performance of the property. So that's one thing that I think is really good, but you want to make sure that that's how your investments are aligned. And you want to make sure that the group that you're investing with really, really knows what they're doing. There's a lot of like humdrum marketing out there. There's a lot of gurus out there. There's a lot of marketing tactics that let people show like they have a lot of experience, but they really don't. So you've got to get hyper focused into who am I investing with? What does their team look like? How big is their team? What do they do when things go wrong? How do they adjust in down markets? What do they do when things aren't going as planned? Because really, and this isn't something that a lot of investors, especially new investors, want to hear, but no investment goes as planned, right? Not one. Now, that could mean it goes way better as planned, but things will go sideways too. So you want to make sure that the group that you're in bed with knows how to adjust. They know how to react when things do go sideways and get them right back on track. And you want to know that they plan for things to go wrong and they have some kind of buffer built into their models. So that's the biggest thing for me is you are outsourcing that responsibility to somebody else. So you want to make sure that they are really, really up to snuff and able to deliver that for you.
Man, that was a nugget right there. Literally underwriting the team. I mean, it's easy to get sold in this stuff. It's like they're competing. It's high competition, but like literally having the team tell you, no, we actually know something's going to go wrong and we're planning for it. And here's our hedge, Yeah. I think that's really important, outsourcing that control and not to just do it. They're making it easy up front. Even they're going to make it easy up front and after, because this is a passive investment. But that doesn't mean you're not actively doing due diligence on who you're giving your money to. That's a very stark distinction we need to make. Like, the work involved here, even though it's a passive investment, is you got to know who you're giving the check to.
Yeah. That's a big thing. Is I would say most investors, they spend a majority of that due diligence on that group or that operator. So even for us, so what we do is we create funds and invest in other people's deals as well. And so we want to vet those operators really, really closely. Now, once you have an operator or a group of people that you really know, like, and trust, it becomes a little easier, right? You just have to look at the deal or look at the market they're investing in. And, we have groups that we really like and trust, but we still don't invest in all of their deals because we either don't believe in that business plan, we don't believe in that market, we don't believe in that tenant base, we don't believe that our vision for the macroeconomic landscape aligns with theirs. So just because like, and trust somebody doesn't mean that you're going to send them a check every single time they have a deal come out. We certainly don't, but it does make it easier when like, and trust them, and you kind of have that because that's where you're going to spend a majority of your due diligence on.
That makes sense, man. And you mentioned fees, and you mentioned performance-based compensation. I think that this is like, if I was going to be honest with you on syndications, if I'm looking into something like this, I have this like tension around, hey, where's the fees? Like, how are they making, because I think this has gotten done wrong quite a few times where it's like, man, they're playing a different game than I am. I'm investing in this property perform. They're investing this property to make them and the investors to make a bunch of fees off of them, right? Like I'm maybe being a little unfair, but like this is a topic, right?
Yeah. So I think there's so many groups that I've seen structure their fees a different way. Now, there are going to be fees involved in it. Now, part of those fees are legitimate and part of those fees might be getting a little bit gracious, but you want to see where they maybe taking and pulling different areas from or giving and pulling. So you might have an acquisition fee anywhere between 1% and 3%. You might have an asset management fee between the same 1% and 3%. Now, I wouldn't expect them both to be 3%, but if one is 1%, the other's 3%, or maybe they're both 2%, those kind of level out, right? So you want to look at where they're going. Now, everybody has like a market rate for fees, I feel, in every industry right now. I don't know whenever you as a listener are listening to this, what those market rate fees will be. But for now, what you want to do is look at a few different packages, look at a few different offerings and ask a few different groups, hey, what are your fees? And you'll start to notice pretty much the same patterns. Things like, let's say, the acquisition fee percentage, the asset management fee percentage. Sometimes there's a loan signing fee because the general partners do take on all the downside risk of the loans. So sometimes there's a fee associated with signing on that and taking on that liability. Just get those lists from different operators and then just benchmark them. And then you can ask, hey, why are you guys charging a 3% fee when some other groups I'm seeing are charging 2%? And maybe they'll tell you, oh, well, we're actually giving you 5% extra equity in exchange. Okay, that might make sense to you. So just grab a few. You're not really going to know where the market is until you're looking at a lot of deals because these things might change, as times go on or as different business structures come into play.
Yeah, and that's really great advice. I think if you're looking at pros and cons from, investing input costs or like during the course of performance, versus you doing it yourself or investing with a group, there's going to be some of these management style fees, right? And then you mentioned the performance-based model, which is, probably incorporates some fees and performance, but it's heavily weighted on if the property and project performs. I mean, I like the sound of that. That just makes sense. Explain that a little bit more, how that works for you guys.
Yeah. When we look at a property, we look at, of course, we run a business too, right? So we need to know, hey, what's our projected income for taking on the property? We need to make sure we can keep our lights on and pay for investor portals and all the expenses that we have as a business. Now, when you look at things, most of the time, a lot of that compensation actually comes from equity gains. So you might see a package and it'll say something like, we're running an 80-20 split. What that means is the investors are going to get 80% of the equity and the general partners will get 20%. Now, the general partners might also charge some fees, but if you really, really dig into it, a lot of those fees go towards keeping the bills paid and keeping the lights on, because what happens is the general partners really may not make a good payday until the property sells. So you're talking, 3 to 5 to 7 or more years until that property sells. So they really want to make that equity very valuable to make it worth waiting that period. So a lot of that compensation is going to come in there, 20% equity split. So there's a really, really aligned incentive to make that property work very, very well. Every, dollar of value they add to that goes to the bottom line in the final valuation. So that's a really, really aligned incentive. You want to make sure that that's there for sure.
That makes a lot of sense. And it kind of feels like everybody's rowing in the same direction. Again, this all goes towards doing due diligence on how this syndication or fund is structured. If you were going to give us like a quick hitter, I'm putting you on the spot, like a quick hitter due diligence for somebody that's investing, they're like, I'm going to invest into syndication in 2024. Just don't know which one. Like, give us your quick hitter due diligence checklist, maybe in as many as you can.
Man, I think I might have something even better for you. I did a really in-depth episode on our podcast, and if it's easier, I can even give you that link. We could put that in the show notes, and then we can go straight there. It's the Passive Investor Due Diligence Checklist. It's free. There's no anything required. I'll just give you the link for it. But really, really high level, you want to start at the operator, and there's a couple of things that we look at. We look at the number one thing is the size of the team. All right. Experience is a very close second, but where a lot of people are looking at experience, there's a lot of scenarios where, especially in the past few years, the market could have made a lot of these operators look very good, right? The market was been white hot for the past couple of years. It wasn't uncommon to put up 40% IRRs and 30% IRRs and really overperform. That doesn't have as much weight to it anymore. So I want to see what your experience has been during recessions and throughout different market cycles, and what your team looks like. Personally, I don't really invest with solopreneurs or mom and pop operators or, spouse teams, just because I feel sometimes life gets in the way, or people have accidents or get sick or have to leave for sudden reasons. And I don't want the investment to be in jeopardy for that. Not to sound too cold-hearted. I'm very concerned with them and their health, but Kevin O'Leary has this very famous quote on Shark Tank. He says, what happens if you walk out this door and gets hit by a bus? What happens to the investment? So I want to know that I'm investing with a business that has systems and staffing and employees that, one person getting sick or, a car accident is not going to derail everything. So that's a really, really big one. Another really big one for the market that you're investing in, especially for apartment buildings, especially in late 2023 and 2024, is not enough people in the past years have looked at rent to income ratios in the markets they're investing in. What that means is, how much income are the tenants that we're targeting for this property making, and what's their rent relative to that? You have these markets in Phoenix or these DFW areas that are pushing 40 to 45 to 50% ratios, meaning that tenant cannot pay you anymore. Doesn't matter what you do, how nice you make it, or where, like, you can't do anything else. You have to wait for the market and their incomes to catch up to your property now. So a lot of people got in that hole over the past couple of years, and we're starting to see rents decline, which I actually think is healthy. Those are artificially inflated anyways, but you want to make sure that you're in these properties or in these markets where the tenants can afford to pay you, and you can actually approve people because they make enough money to live in your building. So those are two very, very high level ones that I think are really missed, especially from newer passive investors. And again, I'll give you the link. We can put the episode that I did in there. It gives a few more that are really important, keeps it pretty high level. But if you start out there, you're already going to be head and shoulders above a lot of other new investors.
Wow, those are great tips, man. That was really insightful. And especially just knowing like, hey, I might have this big, beautiful concept photo or building that was going to get bought in this remote location or this market that I'm not familiar with, but the rents might be way too high for the people to afford them in that area. And it's like, why isn't this working? Well, the incomes need to catch up. That's a real problem. Mm-hmm. And so it's like, man, it might look awesome. It might have all the amenities, but in order to have those, the project has to crank up the rents. Just knowing that ratio, like what ratio, obviously the lower the better. But it still has to function. Like, what do you see that, in that 20 to 30% is still, is that too low, or is
20
that like,
to 30
okay,
would be really good. I mean, 20 to 30 would be really good. Most of the time when you're looking at an application, you want them to see 3 times the amount of income for rent. So, at the very least, you're going to look at that 33%. But, in some markets, like we love Kansas City, we have a deal here right now that we're going through, and the rent to income ratios are 19%. So that's like a very, very healthy market where tenants have a lot of money and they can't afford to pay for a premium product. So that ratio, the lower the better. I think realistically, if you're at about 20%, that's very, very good. Up to 30%, you're still doing good, but just know you probably are not going to push those rents, a couple $100 more. And it depends, right? Like if you're if you're advertising a $2,000 product, like a class, B plus or A product, is $100 on top of that a big deal for that tenant? Not really. Probably go from $2,000 to 2,100, but to go from 600 to 700 is a massive jump for maybe that blue collar worker or that retail worker. So it kind of depends on what your price point is too. But yeah, you want to look at those ratios and make sure that the market can support what you're looking for.
Yeah, that's a really cool piece to kind of dive into, and definitely is sparking some things in my head. But yeah, that's a cool part, and we will definitely put that in the show notes. That checklist that Justin just offered up in the podcast. That's going to be a cool resource for the listeners.
Yeah.
Let's talk the tax benefits. People a lot of times say, "Hey, I want to get into real estate because of the tax side." That's a unique thing with this.
Yeah.
I have it. I'm bringing it up in like the cons section because I'm thinking, do you get the full benefit of investing in real estate if you're in a fund, in a syndication, or do you get partial? Like, how does that work?
Yeah, you should get benefits passed down to you. Yeah. Okay. At least that's how I see it be done most of the time. I don't know any really solid and reputable operators that keep all the benefits for themselves, but you should get those tax losses passed down to you. Now, I have this guy in the tax world that I know, and he says he says this one thing, that very, very wealthy people invest in real estate for two things: the appreciation and the depreciation. So you want to be able to show taxable loss, not real loss, but taxable loss, so that you can essentially defer your taxes and defer the gains from your real estate investments until you die. And that's a law that is beautifully written into our tax code in very complex ways that politicians use themselves. So I don't envision it, even though it's a hot button issue every election cycle. They all use the same benefits. So I don't really envision it really being under threat just yet, but the tax benefits are insane. It's the way that Donald Trump can be on a stage in front of hundreds of millions of people and say he pays no taxes and it's completely legal. It's sophisticated people are doing these things, and they're available to you as well when you're in funds and syndications.
Very cool. Very cool. And is that an appropriate question to ask during due diligence? Is that like, hey, how much of this do I get? Because I'm splitting the benefit based on how much I'm a part of this fund, right? Like, am I thinking of this the right way?
Yeah, that's a good way to think of it. Typically, they'll be able to give you a range. They'll say something like, we're projecting about 50% of check size for your depreciation value. Meaning, if you write a $100,000 check for the investment, you'll get about $50,000 of depreciation, which you can use to offset gains in other investments or in that investment itself. And you got to consult your own CPAs for these things. We're just kind of talking about generally accepted practices, but if you go to your CPA and say, hey, I'm looking at about a $50,000 depreciation loss, where can I use that? They'll be able to give you a pretty good sense.
And is that something, and this will be my last piece on the tax stuff, which I'm like quizzing you on tax stuff here, but that was really helpful. Is it something that you get every year? Is that carries with you if it's a 5-year thing? Yeah. It carries.
So those will carry forward. Yeah, those will carry forward. And again, historically, you can use them even with other gains against other passive income. So a lot of times what you'll have people in different deals, and we'll have investors like this. They'll say, hey, I need a deal to close before the end of the year because I had another deal that sold and I'm looking at about a $100,000 gain. So I need some depreciation my way to wipe that out. What do you got?
Yes.
So that's a big one. Your capital gains taxes are pretty hefty. And so a big part of this game is not just making the money, but keeping it. And real estate is one of the best ways to do that right now.
Cool, man. Thanks for touching on that. And I want to break into this part. I touched on it early in the episode. For anybody that's thinking about kind of getting on the GP side, like talking active with this, and I just because you're in it, you see it. I just want you to give some guidance to any listeners that are like, hey, I've got these 5 buddies, or I've got these 5 relatives, or these people, and I'm let's say I'm a real estate agent, or I'm someone that's familiar with real estate enough to get my head around this stuff, or maybe they're actively planning. They have a property that they're and they're saying, hey, I'm going to go down this GP route. What's your 2 cents? What's your advice for someone kind of getting on the starting edge of starting one of these funds or syndications?
Yeah. Man, that's such a tricky question because I was fortunate enough that I had the means to pay for mentorship. And these are 5-figure mentorship programs most of the times, the good ones. So I think I have a little bit of a warped sense of how fast you can get caught up to speed on these things and really dive into the ins and outs. The first thing is you're going to have somebody on your team that's pretty experienced. If not for your investors' sake, then for the bank's sake. You can't just sign on a $5 million loan and just be, hey, I have a home and now I want to buy a 50-unit apartment building. It doesn't really work that way. I would say most people get their start by investing passively. They kind of start to see the ins and outs. They gather themselves and a couple of friends, and then they say, hey, can the 4 or 5 of us create $500,000 of equity amongst ourselves? Okay, then you can approach some of these groups and say, hey, can we come in and invest and maybe bring some other investors to your deal? That's probably the more common way that people get started, is they'll start raising a little bit of money first and then hope that snowballs into other learning opportunities. But it most of the time people start out as passive investors. That's what I've seen be the most common journey.
Yeah, and the interesting thing that I love the content around, like, hey, if you're trying to get in this game, go find a deal, right? Like,
Yeah.
and if you go, let's say you go find $1 million deal and the bank says we need $300,000, generally you're almost starting to walk down like, hey, I don't have $300,000 cash, but this is a deal. Everybody agrees. You're kind of walking down like, hey, let's syndicate this, or even you're probably walking down the partnership path more than a syndication.
Mm-hmm.
But this is why this is such a unique system or process of like, hey, this is how you would syndicate, or this is how you'd create a fund.
Yeah, there's so many ways to do it. I mean, you and then you meet people along the way, right? We have hard money guys who sometimes will do a deal that way instead, or if we can't finance with a bank, we'll do a hard money plus some private capital. Like, you could get so creative here. That's why, under the umbrella of somebody says, hey, I'm a real estate investor, like that almost means nothing to me. I don't even know what that means. What do you do? You could do everything. So yeah, there's so many things. So if you want to get started, you got to shake some hands. You got to, meet some people and really get in and find out if this is the niche you want to get into. And if so, I'd start investing passively. I think I'd invest in, maybe 1 or 2 or 3 or 4 deals, whatever your capacity is over the next couple of years, and learn the ins and outs of that system, build great relationships with those operators, and then maybe approach them and say, hey, I've invested in, 2 or 3 of your past deals, and I'm curious what it could look like to, maybe get a more active role, if not with your team, with somebody leverage the connections that you essentially paid for already just with an investment. I paid for mentorship, but you can pay and get some equity from, and get some mentorship that way. So that's probably what I would do to start if I was started all over again.
Cool. Thanks for the share. And, anybody that I have on the show that's like inside of an industry, you being real estate, you see it, mm-hmm. You're analyzing deals. I like to ask the market question and throw all the media, throw all that stuff out, the Fed rate, all that, This is us on this podcast. I want to get real information. What do you think about the current state of affairs with the real estate, real estate in mind? And just where do you think it's going? Like, what's your projection over, I'll give you 3 to 5 years. What do you guys see?
Yeah. This next 2 years is going to be one of the most exciting times to be a real estate investor in my lifetime, right? I'm 30 years old. So, in 2008, I don't know that math, but I was not a real estate buying age. So this is a very, very extremely exciting time. I think there is always a headline that will tell you that this is not a good time to do whatever, start a business or, invest in real estate, buy a property. When interest rates are really low, prices are very high, and no, I want to wait for prices to come down. Then when real interest rates grow and prices come down, well, the interest rate is so high. It's like, a presidential election, I'll wait till next year, which is a real thing. Home valuations tend to drop in presidential election years because there's uncertainty. If you think about that, that's every 4 years. That's 25% of the time, so there's always reasons not to. And I think there's always great deals to be had. Just investment theses might change and investment strategies will change. Right now, because of financial markets, you're seeing different loan products be more viable. And because of that, different strategies are better than strategies that we were using a year or 2 years ago. So it's about adapting your strategy, not abandoning ship when things, I don't even want to say get turbulent, because there's never a dull moment. A lot of times people say, if I'm talking to them and they'll say, yeah, man, I'm just too busy to invest right now. It's like, okay, what do you foresee happening in the future that's going to make you not busy?
Yeah.
Are you sending some of your kids away? Are you planning on quitting your job? Are you planning on getting fired? Are you planning on relatives not being in town this weekend. Like, what are you planning in the future that's going to make you not busy? Well, nothing. You're never going to be not busy. There's never nothing.
The only way you get not busy is you invest and create passive income.
Yeah, exactly. And you got to get a little bit busier before you can do that. Right. So I think, there's 1,001 ways, there's 1,001 reasons not to invest, but there's an infinite amount of reasons to invest. If you're looking for reasons to do it and you're looking for like the upside, you're looking for the opportunity in the markets, you're looking for the gaps in the market right now where other people are zigging and you're willing to zag, like that's where you're going to find an enormous opportunity. In real estate in general, specifically commercial, there's a massive amount of distress coming in the next 2 years. That's just what the numbers tell us. There's bank loans coming due in the next 2 years that some people are going to be in hot water for. And those are great times to be on the buy side of real estate, specifically commercial. I don't think residential sees that. Residential rates are very, very good. Equity built in people's homes is higher than it's ever been. People are sitting on, sub 4% rates. So I think that inventory is going to stay very tight. But in the commercial space, it is extremely exciting. So we're gearing up to buy a lot over these next 2 years. These could be the next couple of years where you set your generational wealth, like the foundation of it right now.
Cool. I love that. I'm going to let that sit. That's really cool. Justin, before we close out, man, I want people to know where they can find you, see what you're up to. I know you have some shows, some podcasts you host, and you're active on social. Like where would you point people that want to learn more about you and what you're doing?
Yeah, if you're a podcast listener, which I'm assuming you are listening to this one, we have a show. It's called Passive Real Estate Strategies. We talk all about this stuff, syndications, funds, and REITs. I'm most active on LinkedIn. The President's Club Investor is kind of my tagline. That's where you'll find me. Most of my investors are salespeople. You don't have to be a salesperson to invest with us, but that's kind of who we have in mind whenever we're making these decisions and the investments that we're making. So check me out there. I have tons and tons of resources on my LinkedIn page. If you go to my LinkedIn, go to the profile, I have the little, link in bio, whatever you got there. We've got retirement calculators. You can find out how you can retire in 10 years. We've got ebooks for you. Man, if this is something you want to do, check me out on LinkedIn, President's Club Investor. That's also the name of our company. So check us out.
Cool. Awesome. Justin, thanks for breaking this down. Super insightful. Definitely a cool part of the equation for anybody that's looking to get into this passive income real estate, truly passive. Keep crushing it, man. Thanks for being on. And I'll end the episode asking the audience, what's one action step you can take away based on what you heard today? Don't wait. Action is key. And if you're currently on your passive income journey, reach out, tell us your story. We truly believe we can accomplish financial freedom better together. This has been another episode of the Passive 25K podcast with Kyle Reedstrom. If you liked what you heard today, I encourage you to subscribe to our YouTube channel and like this video so we can get more of these conversations out to people that are curious about starting their passive income journey. And if you are thinking about starting your passive income journey, the next steps are to go to our website at p25kg.com and hit apply. This will get you into our application to join our community called Passive Income University, where you can learn everything there is to know about starting and completing your passive income journey. Thanks again for tuning in. I'll catch you next time for another conversation on the Passive 25K podcast.